The repo rate and reverse repo rate are two key tools used by central banks, such as the Reserve Bank of India (RBI), for managing the money supply and controlling inflation. Here's a breakdown of their differences. 1. Repo rate. Definition: the repo rate, short for repurchase rate, is the rate at which commercial banks borrow money from the central bank, like the RBI, by selling their securities, such as government bonds, to the central bank with an agreement to repurchase them at a later date, usually short-term, overnight. Purpose: it is primarily used by central banks to control inflation and regulate liquidity in the economy. When the central bank raises the repo rate, borrowing becomes costlier for commercial banks, which can lead to higher interest rates for consumers and businesses, thus reducing the money supply and controlling inflation. Function: the central bank lends money to commercial banks, injecting liquidity into the banking system. 2. Reverse repo rate. Definition: the reverse repo rate is the rate at which commercial banks lend money to the central bank by depositing their surplus funds. Essentially, the central bank borrows money from the commercial banks for short periods. Purpose: it is used by central banks to absorb excess liquidity from the banking system. When the reverse repo rate is increased, it encourages commercial banks to park more of their money with the central bank, reducing the money supply in the economy and helping to control inflation. Function: the central bank borrows money from commercial banks, absorbing liquidity from the market. Key differences. Aspect: repo rate, reverse repo rate. Meaning: rate at which central bank lends to banks, rate at which central bank borrows from banks. Purpose: to inject liquidity into the banking system, to absorb excess liquidity from the banking system. Impact on money supply: increases money supply by lending to banks, reduces money supply by absorbing funds from banks. Banks action: banks borrow from the central bank, banks lend to the central bank. In short, repo rate is about the central bank providing funds to commercial banks, while the reverse repo rate is about the central bank absorbing funds from them.
Hey guys, this is the end of the today's class. If you like the video, please cooperate. Thank you for watching.